In a desperate move to fix a broken housing market, the US is looking to roll out 50-year mortgages. Let's make it clear. We're talking about a loan designed to outlive the borrower. It offers short-term relief, but it locks in a crippling multi-generational price tag. Today, we're looking at the terrifying math of the 50-year mortgage, what it does to your interest, what it does to your wealth, and the exact reason why Canada will never allow such a product this dangerous on its soil. Let's dive right in. Hi, my name is Zen. If you enjoy my data-driven and number-crunching real estate updates, be sure to like and subscribe. Americans may soon get the option of 50-year mortgages. And I've gotten this a lot in my career where a lot of my clients would be like, why do we not have these 30-year mortgages? And why do we not have that ability to lock in for that rate? Because a lot of us Canadians are envious of the way the US mortgage system works. And the reason why you may not want to be that envious of longer mortgages is because of three things. And these three things always happen when we talk about higher amortizations. One, you're going to be paying a higher interest rate, so a term premium for longer mortgages. Two, you're going to be paying more lender fees. And three, you're going to be paying more interest on the entire duration of your mortgage. So it may not actually make that much sense. And in this video, I'm going to go through the pros and cons of having a longer mortgage. And they do actually exist in Canada. It's just most people actually don't know about it. And there's a reason why for that, because most people just default back to your standard 5-year variable or 5-year fixed. And one of the reasons why we're getting a lot of chatter online about, why we can't have longer fixed rates really is because we have 1.8 million homeowners that are going into a mortgage renewal that's coming up. And you can see this is a chart that talks about the best 5-year discount mortgage rate. So this could be fixed or variable. And most people get 5-year terms. So you can see we're coming up into that part of the cycle where during the pandemic, we got 1% interest rates going all the way back to here. And you can see it was around 2021. So when you add 5 years to that, you get to 2026. So in like 2 months, 3 months, 4 months, 5 months, we're gonna have a lot of these people who have got a 5-year fix that are basically going to renew and go right up to there at a 4-year rate. So they're gonna be quadrupling their rate. But for anyone who has a mortgage that's 5-year fixed that's in this position, do not be concerned. It's not like your mortgage payments are going to quadruple. They may not even double. You should do the calculation yourself, or I'll put a link to Mortgage Calc below. And even though a lot of these homeowners in Canada really are looking for some kind of stability and 30-year mortgages because they're seeing this massive interest rate increase, just understand that there is a cost. And that cost comes with, like this what article is saying, it comes at a price, hefty upfront fees, and higher rates. And let me show you what all three of these are about. Before I tell you and explain to you why a 30-year mortgage may not be the best thing since sliced bread, let me explain the technicality to you why we as Canadians actually do not have it. So in the mortgage space, you have to understand there's two terms. There's the mortgage term, which is how long that mortgage lasts for. So that's like 3 to 5 years in Canada. That's traditionally in the conventional way. Whereas US has the 30-year mortgage term. Now, don't confuse that with amortization. And amortization is basically the length of how much time you have to pay back your loan. So say in like a 30-year amortization, you could have like 6 chunks of 5-year terms to pay off a mortgage that you owe. So in US, they have long amortizations and long-term mortgages. And that's because there is a company that's sponsored by the government in US, and you may recognize the name. It's called Freddie Mac and Fannie Mae. And what they do is they basically go to the banks that have lent out these mortgages, and they're like, hey, bank, I will take that off your book. So, you don't have to owe that as a debt. And I'm going to package all of these things back up as the government, and then I can sell these bonds. These are called mortgage-backed bonds. And if you kind of remember the short, it's because people were sweeping these subprime loans into these mortgage-backed bonds, and that's why we had the great financial crisis. And because they have Freddie Mac and Fannie Mae as an intermediate to take them off the books, they have a long-term horizon, which allows them to provide 30-year terms. And it matches up with these 30-year bonds. And that's basically like the technical reason why they have it. Whereas in Canada, we don't have a Freddie Mac or Fannie Mae that's in the middle. The Canadian banks, so like your RBC, your TD, and your CIBC, they basically hold on to your mortgage debt, and they actually have no one buying it up. So if you are the Canadian bank and you basically cannot control the rates, why would you take the risk of lending a mortgage term longer than say like 3 to 5 years? Because if the interest rates goes up and down, you could lose money or make a lot more money, and they don't want to take that risk. So having that fluctuation between 5 years is just easier for them. So in order for the Canadian banks to have 30-year mortgages, they need some kind of government backstop or some way, shape, or form to basically de-risk themselves from lending the money out for 30 years. And until some kind of Canadian institution comes up with that or creates the Canadian equivalent of Freddie Mac and Fannie Mae, we're not going to get 30-year mortgages. But shouldn't be concerned about it anyways because they do come at a hefty price. So let me show you. Most people actually do not know we have a 10-year fixed mortgage, but most people just don't take it. I know of one person who took a 10-year mortgage when rates were super low and was at 3%, but it was such a contrarian move because everyone's getting rates at 1.5%. So you can see on this website that tracks the lowest rates that CIBC, one of your larger banks, is offering a 10-year mortgage term for 6.79%. Would you take it? Knowing fair well that the 5-year fixed right now is at 4.19. That's like a 2.5% interest difference. And this is exactly why Canadians don't take it, because it has what we call an interest rate term premium, or basically the interest rate is higher. The second reason really is that when you go get a mortgage in the US, there is something called a lender fee, where you actually pay a percentage of your loan at the front, like closing costs. It's similar to like a land transfer tax on closing for us right now in Ontario and Toronto, but they have that on the loan side. So if anyone who's ever gotten like a private loan or a B lender or even sometimes an alternative lender, they have a lender fee because the person lending you the money, so either be a B lender or like a US bank, they're collecting some revenue at the front to mitigate any losses in the back end. So if you don't want to pay that fee, this is why you also have 5-year fix. So that hefty upfront fee is almost a cost to play if you want a longer term mortgage. And the final reason for not having longer term fixed rate is in Canada, we have something called the IRD, which is the interest rate differential. And all that's basically just fancy schmancy talk at banks for saying, hey, if you break a fixed mortgage, we're going to charge you a crazy penalty. And that dollar amount literally fluctuates every day depending on what the posted rate is. I've seen this IRD go as high as 3 to 4% of the actual remaining loan, depending on how long that is. So if you're at 4 out of the 5 years remaining on your fixed rate mortgage, it's really, really substantial. But imagine you had to sell your property, like this article is saying, 2 years out of the first 10, that 8-year fixed rate will wreck you. It could be like 7, 8, 9% of the actual loan. So in our mortgage, if the average price is $1 million, your mortgage is 800 grand, 8% of that, you're paying like $60,000, $70,000 in interest rate just to break the mortgage. That's going to be costly. And that's how some banks will be justifying the cost. Now, can the government change that? Yeah, of course. But are they going to? Probably not, because the major banks have an oligopoly. Yeah, that's how it works. The other interesting thing is when you have mortgages that go out to 50 years, it obviously means that your amortization stretches out to 50 years. And there's good and bads to it, right? So in this case, when you increase your amortization to 50 years, you're going to be increasing the amount of interest you pay by quite a lot. And you can see over here, so this is a side-by-side comparison showing you that if you actually have a longer amortization and a longer mortgage term of up to 50 years, you're paying significantly more interest. So on the left-hand side, you have an amortization or loan term of 30 years. The right side, you have a 50. And you can see most people, when they're buying a property and when we talk to most buyers, they really care about the monthly payment, which is about $4,200 in this scenario at $1 million and 20% down and a 5% interest rate. And when you do that over 50 years, your payment is $3,600. So realistically, you're like saving anywhere between $600 to $700 a month. And this is important. And this is why I think some people will actually want the 50-year amortization. It's because if you are a first-time homeowner and your purchase price is so high that it's completely out of reach for most people, the only way you can get into the system is by having lower monthly payments in Canada, which is by lowering your GDS or TDS that I've talked about in different videos. Because the lower the percentage that your household income goes to servicing the home, the larger of a home you can actually get. So in this case, this is a pretty substantial decrease in GDS and TDS, which allows you to ultimately qualify for more, which ultimately allows you to buy more home. But the problem is, you can see you're paying significantly more interest over here because of the amortization schedule. So you're paying about 63% interest and 37% in principal on your first payment. Whereas if you're doing the 30-year term, you're looking at about 50-50. And over the entire life of your mortgage, you're looking at about $750,000 in terms of interest that you're paying for the 30-year. But when you look at your total interest, it's almost double on the 50 years. So this is math that most people don't understand. And unfortunately, this is just way too complicated for the normal person, unless they're really into nerdy financial stuff like this, to actually understand. So there's pros and cons to having a 50-year mortgage and amortization term. It does inherently allow people with lower incomes to get into the housing market. So it allows them to have that Canadian dream or the American dream. But unless they're really savvy and understand all this, they're going to be paying almost twice the amount of interest. But what's the cost, right? Is the juice worth the squeeze? And I would say a lot of people who want to own their home would say yes. Yeah, maybe I'll be dead before my mortgage. Maybe I'll pass it on as a, generational mortgage. And that actually does exist, by the way. I'm going to show you a bit later. But it allows them to own their home, and that's maybe the price that they're willing to pay. And just understand that in Canada, we actually at one point had 40-year mortgages. They say mortgages here, but what they mean is amortization. We kind of nixed that in 2008. And the reason why OSFI, the banking regulator, removed it is because they cited it as risk to the housing market. And in case you were not around buying homes in 2008, they had these magical things where you could do 0% down, CMHC backed mortgage insurances at 40-year amortizations, which goes crazy for cash flows. And they will also give you some money for the closing costs. It was absolutely ridiculous. It was like literally 0% down to buy properties. But, because of risk, they removed it, which actually is probably a good thing, just like the stress test. And this is exactly what this article talks about, where we did have it before, but then we removed it to come to our senses because it is a nightmare of a cost. But a lot of the times people are going to justify, hey, if you lower the amortization, it allows first-time homebuyers to get in the market without crashing prices. And this is where it gets a little political, because one of the ways to increase the percentage of home ownership really is to increase amortization. And I've been saying this for quite some time. If we wanted to juice the market, we would increase amortization because it allows more people to get in the door. And at the same time, it doesn't upset the homeowners who use their primary residence in Canada as a retirement vehicle. So you basically please the elderly and you please the young being able to get into the housing market, and the old, their assets aren't dropping in prices. But I looked into whether amortization actually changes some prices for this video, and it's very inconclusive right now. Let me show you. So this is a chart that I put together that talks about basically what the multiplier of household income is to the average price of a country. And I also put in the maximum amortization, meaning how many years there are available for a mortgage. And yes, Canada does have 35-year mortgages. People just don't ask for them. Your major banks do offer them, similar to 10-year mortgage, but that's just the unconventional thing to ask for. And then I also put in the most common mortgage term. So for us, it's 5 years. And you can see you're going to have a wide spectrum of properties, where being the most unaffordable being the top three, Portugal, Switzerland, Canada, you have maximum of 30-year amortization. Switzerland has 100. Yes, they actually have generational mortgages, and Canada has 35. But you can see they are of the more expensive nature. But if we go all the way down here, you can see that where things are a little bit more affordable, call it 5 to 6 times the household income, you have 60-year amortization without the prices being juiced up in Finland. Italy is around the same thing. You're maxed at 30 years, but the price to income ratio is reasonable. And in the US, you have 40-year amortization right now with a 30-year mortgage. And you can see in the US where you're having higher amortization and longer mortgage terms and are very affordable is proof that, hey, you know what? Maybe higher amortization and longer mortgage terms don't actually make the market go higher. But we have to understand, this is just one way of measuring things, because housing policy, banking policies, and a lot of other things, and also local regulation, do control kind of like how the real estate market fares. And I will point out that the only other country to have over 10-year mortgage terms is France, and they have amortization of 50 years, and they're like right in the middle of the pack. So it's not like amortizations being increasing is going to be a good or bad, and it may not juice the market, which is why I would not be surprised if we may get in the future if there is enough push and demand from one of the political sides to actually get the first-time homebuyers in the door. And one of the scary things is if we do get longer amortizations and longer mortgage terms, what happens if the market continues going down and your property is underwater for such a long term? And that's exactly what I talk about in this video that's on the screen right now, where we are having a lot of sellers where their mortgages are a larger amount than the value of their home and they actually can't sell. And that's exactly what I talk about in this video that's on the screen. Make sure to check it out. Until next time, your move, your future. See ya.